Do you at RBC Capital Markets perceive declining inflation?
Yeah, we do. We think inflation will slow, and we think you could start to see some slowing show up right around the turn of the year at the core level. Headline is obviously a completely different animal. We'll see what happens with energy prices, which our house call is that they will be on the rise over the coming months. But at the core level, yeah, we do. We think that it'll wind up slowing down before the end of the year. You're gonna have to get through this like one more month of sort of unfavorable year-ago comp. But once you get beyond that, we think that some of the sort of the price pressure that we're starting to see, the downward price pressure, will start to show through. Again, let's be clear, everyone. It's not going to be in some sort of notable, meaningful way. But you will start to see that process slow, again, even as early as before the end of the year. And then as we roll into the next year, I think it's really reasonable to think that core inflation could surprise people to the downside. I mean, there's a lot of price pressure that is in the pipeline right now, a lot of downward price pressure in the pipeline, and we think that'll start to show up.
Well, that's certainly what Marco Kalanovic over at JP Morgan seems to believe as well. Still, others say, well, look at wages and how much they're increasing. Look at some of these stickier elements. Look at food. Look at gas, which is reemerging as a pretty significant inflationary headwind. How do you factor those things in? When do you start to think maybe I'm wrong and the Fed does need to go further than perhaps some people think?
So this is a really great question, and I think that it's important because I can see a plausible scenario where headline prices are remaining, sort of stable at high levels if you do get this drift higher from an energy price perspective, if food prices continue to remain firm. Although let's just be clear, we are seeing signs that food prices are slowing down. But again, just to your point, like just for fun, let's just say that all of that does happen. You could see a scenario where headline prices remain, again, relatively high, but core prices slow. That's a really tricky spot for the Fed, and this is something we've been talking about and writing about for quite some time. The Fed needs to unhitch their wagon from headline prices. They can't control that stuff. They can't control food or energy prices. And I know it's going to be a question of, hey, but what about inflation expectations? Yeah, but I get that. But if inflation expectations are rising because of things that the Fed can't control, then I think the Fed needs to make more of a distinction in that regard. And so we would actually argue that the Fed is supposed to be really focused on core. Powell and others within the Fed have even recently said that that's what they're supposed to be following. But I think they've just got caught up into this loop of they've really only talked about headline prices. I think that's going to come back to haunt them if you actually don't see headline prices slow with core, which is what we expect.
Okay, so let's say the Fed comes out with this nuanced message that you're putting out there, which is this inflationary kind of feel gaining wind next year and giving them more space. If they say that, doesn't the market rip? And this is what I asked Lori Heinel, and this is sort of the conundrum. Financial conditions will move against them, especially considering the expectation for a hawkish speech from Jay Powell.
Yeah, I think that's totally fair in the immediate term. But let's just be clear: there's a lot of challenges in the backdrop right now, right? Like I know some people who keep on latching on to this idea that hey, the payroll report showed acceleration in job gains. I get it, but does it make sense, right? I mean, so I think I heard Tom earlier say, look, labor is a lagging indicator, and he is 100% right. And it's funny to me that people just seem to sort of lose that narrative. So, but let's talk about the acceleration in jobs, which people are still talking about 2 weeks, after the report, or 3 weeks, whatever it's been. Jobless claims are up. Even if you make the adjustment for the sort of the seasonal factor thing, they're still up. They're up about 30% from the lows. That tends to be consistent with potential seeing job losses shortly thereafter. Also, it happens to coincide with countless companies talking about the idea of laying people off. Two, I think you have to keep in mind that the ISMs, all the labor indicators within there are now below break even. The labor differential from the conference board, that's now starting to roll over. Hours worked are actually sliding. It's not something you would expect to see if labor was actually that tight, and that's actually taking average weekly earnings with it. I mean, there's a host of things, and by the way, there's more, but I'll just say this one last thing. The cherry on top of all that is volume of spending is slowing. I mean, I don't know what more people need to see to understand that actually things are squishier than is appreciated.
Tom, on the same page with you is David Rosenberg, who partitions inflation like you do wage growth. And David Rosenberg publishes this morning that housing is approaching what he calls a tailspin. Is the ginormous shock of the end of the year, which is the housing microdynamics fold over to rent dynamics, which flat or even stabilize?
Yeah, so look, I think it's really easy to say that housing is in a recession right now. I mean, I don't think that's a heroic call in any way. I think most people probably appreciate that, or many people are, I think, are growing to appreciate that. I think prices are going to start to fall. Outright decline. I think that could actually happen again even before we get to the end of the year. These things take time, though. I mean, it's funny. I sort of been chuckling. I guess macro is such in focus, and maybe these are conversations that we should have been having with people over the couple of decades that I've been doing this. These things take time to develop. If it's already in front of you, right? Like if everything that I'm talking about is so, or if housing is falling into recession, the consumer's already slowing, then it's too late, right? Like it's like you have no leading, there's no lead there. I mean, we're talking about things that take time to develop, and it seems pretty clear to us that we're moving in that direction, that things are slowing more meaningfully than is appreciated.
Some of these things, though, Tom, are the objective. They're the objective, and I wonder when we get to that more problematic phase. And I just wonder how high the hurdle is, not for this Fed to cut, but for this Fed to pause.
Pause. Jonathan, I agree with that. I think that the real risk here, look, we have our view, right? Our view is that the Fed basically stops by the end of the year. I mean, you're going to be at 350 and the hiking cycle is going to be done. But I think the real risk, and let me be clear, I think that's absolutely the right move. Get policy into somewhat restrictive territory, let that marinate, and then I think we'll be in fine shape next year, relatively fine shape. Make no mistake, things are going to slow. But the real risk is that the Fed does not unhitch its wagon from inflation, particularly headline prices, and that they just keep on going. And I think you guys are going to Jackson Hole. By the way, I'm disappointed I'm not speaking to you in Jackson Hole. I was hoping to see a bear rolling around behind you. I think the one thing that people need to...
Thanks, Tom.
Porcelli.
Eating marmot.
Tom, I heard how nervous you are about this. It's hysterical to me. By the way, if you want to see bears, come up to where I live in Westchester. There's bears everywhere. It's actually amazing.
But they're not grizz.
But I think
They're a lot in Wall Street, too.
I'll have you up for drinks one day, Tom. We'll talk about bears. So I think
you got my attention.
I think the one thing that is really compelling, and the thing that I think we really need to hold the Fed's their feet to the fire on is, what do they really want to see from inflation? Because if you're waiting for inflation to get to 2%, funds are going to be meaningfully higher than anyone appreciates. I don't think that that's what they're going to do. I think that they know better than that, and I think they just need to sort of sell that narrative. But I think if I'm wrong, and they actually keep on hiking rates, the hiking cycle will go on for meaningfully longer than anyone appreciates, and the recession will be meaningfully deeper than anyone appreciates.